Welcome back to Metrics That Matter, where we break down the data, trends, and real world insights shaping orthodontic practices today. I'm your host, Marla Merritt, and I'm really excited about today's conversation because we're bringing together three of the most data driven perspectives in the industry. First, we have Dave Ternan, OrthoFi's CEO. It is Dave's first time to join us, so welcome, Dave.
Yeah. No, thanks, Marla. It's a great honor to be on this podcast. You always do a fantastic job, and I have a ton of respect for Chris and Shannon. So just honored to be a part of it. And then second, I just want to do a quick shout out and thank you to Oliver Gellas. I have a lot of gratitude for all that he's done through the OrthoFi journey, and also to the industry for providing insights and data throughout the year. So I know it's big shoes to fill, and extremely grateful for what he's done for this podcast.
Yeah. Well, we're excited to have you joining us, Dave. And then, of course, we also have our Metrics That Matter veterans, Shannon Patterson and Chris Bentson from Bentson, Koppel, and Patterson. Thank you both for being here too.
Great to be here.
So, today we're going to dive into what we're seeing from Q1 2026, and then more importantly, what it all means for the rest of the year and beyond. We'll talk about growth trends, shifting patient behavior, the evolving role of DSOs, and where practices should really be focusing if they want to win in today's environment. So you can tell from that list, we got a lot to talk about today. So, Dave, I want to start with you. You have one of the largest real-time data sets in orthodontics through OrthoFi. What did Q1 actually look like across your fleet, and what stood out to you the most?
Awesome. Thanks, Marla. So jumping right into Q1, there's some really exciting updates and some interesting things that we're keeping an eye on. So the first thing exciting for everyone is the growth that we saw in Q1. So the growth of starts and production continued from last year. So in Q1 of 2026, we saw a starts increase of about 1.6%, and we saw a production increase of about 3.9%. So that's exciting to continue to see that growth. You do notice that there's a pretty big gap between number of starts and productions. So that's indicating that practices are doing a nice job of keeping up with inflation by increasing their fees. So you saw that in the numbers. At OrthoFi, we've spent a significant amount of time with practices working on benchmarking of what fees should be compared to areas and what else is going on in the industry. Then we've also introduced IMAX, which is helping to minimize insurance discounts, which actually improves production. So that's obviously exciting. From an engineering perspective, the couple things that we're keeping an eye on is first is comprehensive treatment. So I know on this podcast we mentioned that comprehensive treatment has continued to trend down. So it continued to trend down by about almost a full percentage point. So we're seeing more treatment for phase one and limited. So I think people are doing a nice job of listening to this podcast in terms of hearing about ensuring to do limited treatment when the time is right for that. So we're continuing to see that in the data. The other very interesting thing that we're seeing is around new patient exams. So we did see an uptick of scheduled exam, almost 5% more year over year, but kept new patient exam was down by about 2.5%. So with less people showing up than they did the year before, that probably is likely pointing to some sort of shopping or some other things that are going on in the economy. But the things to note is if you have less exams, but you're getting more starts, it's implying that the case acceptance is actually increased. So nice job with the practices, increasing the case acceptance for the people that are in there. The thing that we're going to keep a close eye on is, are we pulling from the observation pool and not refilling it as much as we did? Because that's obviously great in the short term, but could have some longer term impacts.
Great. Now, as our listeners know, we're really privy to two unique perspectives because we do have the OrthoFi data, but we also have gauge data that Chris and Shannon are constantly analyzing to see, the broader industry and then the OrthoFi customer set. So we have some comparison points there. Chris, when you look at the gauge data across the broader market, are you seeing the same story as Dave just mentioned, or something different?
Yeah, I think directionally very, very similar. And, I'd like to thank Gage for allowing us to look at that data and share it with you. And also like to thank Dave. It's nice to have a CEO, and I think it points to the importance that not only OrthoFi, but Shannon and myself place on this podcast. It's getting it from the top. So thanks. But yeah, directionally very similar. I like Dave's numbers better, actually. When you look at the gauge data, um, we got production up 2.7. The OrthoFi data set was 3.9. We had collections up 4.4%. And Dave alluded to fee increase contribution. And, so good job on that. That's nice to see. When you think about 4.4% up on collections with an average independent practice owner doing $2 million, that's $88,000. And when you factor in the cost of goods, that decreases your overhead by about 3.5%. So, doctors should feel better about what they're seeing in their checking accounts, which is great. New patient growth engaged was quite a bit lower than the 5% that the OrthoFi data said. It came in the gauge data at 1.2%. Not sure why that is, but the good news is it's growing. But to Dave's point, fee increases are making up for the increase in collections, and it points to some matters that we'll talk more about as we go through the webinar. Conversion rates were steady. They were up a little bit in OrthoFi. Again, it's good to look at Dave's numbers versus Gage's numbers this quarter, but directionally they're pretty much up. I would point out that delinquency, has some signs that it's titching up. We'll touch on that as we go through, but that's when gas is $4 a gallon and the consumer's paying more at the grocery store and for other things. That's not too surprising. But I think all in all, what both data sets tell us is that growth is here. I've been talking about that for a long time. But the funnel's really tight. And so it's really important what you do in the front end of the funnel. But overall, good numbers for Q1.
Great to hear. Great to hear. Shannon, now from your vantage point, how do you interpret these numbers? And do you feel this is a healthy growth environment, or are there warning signs that we should be looking for?
A little bit of both. So I do think the growth is real, but I do not think it is demand driven. We're seeing a lot of add-on production by practices to increase those production numbers. So efficiency, add-on production, and fee increases are really what's driving performance. I think there are some early signs of consumer pressure on discretionary services, and the consumer sentiment index dropped significantly in March. And this is all tied to world events that Chris just mentioned. But that is a significant collapse in consumer confidence, and it also has a direct implication on discretionary spending, especially for health services. What this looks like at the practice level is it's just kind of the early warning signs. So translating the macro into what orthodontic practices should be watching and leading indicators to monitor now as things either get better or get worse. Is new patient call volume is declining. The first place the consumer hesitation shows up is typically 60 to 90 days before it hits. So make sure that you're monitoring your call volume. Longer time from exam to decision. Patients are taking more time between the consult and commitment, which is a classic sign of budget anxiety. Increased payment plan request and financing dependency. So again, those consumers are definitely looking for flexible payment terms. Case acceptance rate is softening just a little bit with the gauge data. I'm not sure how the OrthoFi data was on that. And the no-show and cancellation rates, as Dave indicated, are ticking up. And that is obviously a behavioral signal that patients are mentally deprioritizing the appointment. So those are all things to look for.
Yeah. Now, Shannon, when you and I were talking earlier, one of the most interesting things you shared is that seasonality is shifting. So for years, practices have relied on a very predictable cycle for when their busy times were going to be, but that doesn't seem to be the case anymore. Talk to us about what the data says about the seasonality.
Yeah, so shout out to Gauge. I dug into their data to find this, and I thought it was really interesting. Patient flow patterns are definitely shifting. And what practices need to know about the calendar shift are the best months that are shifting are best months for new patient calls and new patient adds. So again, a call doesn't necessarily turn into an ad, but an ad should turn into an exam. But July, January, and March are the best months for new patient calls. And with only one of those months remaining ahead, now is the time to be aggressive on new patient acquisition. Make sure that those phone calls are being answered, and that you're turning those into exams. Best months for new patient exams are June, July, where it's high for number one, April and October, which is a big shift. Several of those months are still ahead. So this is your practice window to really sharpen on patient experience in the exam process, invest in TC training, and optimize consult efficiency. One thing that I also noticed is same day start rates were really down in 2025. And personally, visiting a lot of practices, I think that the pre-consult verification on insurance is a likely primary driver here. So when I say, working on your efficiencies for when those new patients come to the practice is making sure that that verification has been done before they get there. So hone in on those processes. Best months for starts are July, January, and April. Again, big shifts. That used to always be June, July, and August, and we've seen a big shift. April is a big month for tax refunds. And when we look at businesses out there in the world, everybody markets to use your tax refund dollars. Cars, refrigerators, washers and dryers, but I don't see orthos doing that. And it's a great time to really be able to promote, hey, use your tax refund for, a beautiful smile that lasts a lifetime. So when we start to see discretionary income become tight due to gas prices and things like that, these are windows of opportunities for key growth for practices. And something else I noticed is the data is showing that we're still doing a lot of discounting fees. And that's kind of like where we see that correlation, of the production and the collections. You're working really hard to get those patients in the door. We would rather see you not discount your fee, but make it more flexible with, payment financing options.
Awesome. Now, to our listeners, that piece that Shannon just gave you was packed full of great information for things that you need to think about and be implementing in your practice. So press rewind, listen to it again, and then we'll move on. So now, Dave, Shannon just mentioned something really important, the gap between scheduling and then actually getting patients to show up and start. What are you seeing operationally that practices can do to close that gap?
Yeah, great question. And obviously we highlighted where the kept new patient exam percentage, the people that are showing up has gone down year over year, at least for the OrthoFi fleet. So it's indicating, some consumer concerns, or maybe they're not as committed to the actual exam, or they're shopping and that type of thing. So the things that I see successful practices focusing on is two things. First of all, ensuring that there's good availability and at good times. So think scheduling the new patient in days, not weeks, and then making sure they have good times available, potentially after school and that type of thing. There is a correlation to how long you schedule out to if they show up or not. So I know a lot of people are doing great with shorter booking windows, so I continue to lean in on that. I think the second thing is Shannon pointed to a lot of things is a really strong pre-consult protocol. So obviously, handling the new patient exam call is a key part of that. Getting the insurance verified before they show up and giving them an indication that they do have insurance. And then the personalization is really where you can distinguish yourself between other practices. So that personal confirmation call or video or text and things like that that's engaging engaging the patient, allows them to have more connection with you than the other practice. So if they're going to multiple ones, there's a reason for them to come to your office versus somebody else.
Right. One thing that I love about these podcasts is that we have Chris and Shannon joining us who really have a unique pulse on the industry because they do work with, you guys work with so many practices, but then some of those practices are also working with other consultants. So you kind of, get an eye into different things that are trending in this industry. So, Chris, I know you've mentioned that you're seeing consultants focus more, or some of the consultants focus more on the front of the funnel and marketing. Do you think that this focus could be contributing to where and how practices are falling short right now?
Yeah, it's an area of need. I think for most of my career, the metrics we tracked were how many new patient exams do you have and how many of those converted to a start. But now there's a lot of attention into how many times does a phone ring, what happens on that call and so forth. So, I think the biggest opportunity that most practices are missing is not having to engage in a new expensive marketing program or thing like that, but to take what is coming to them now and do a better job with it. And that starts before the new patient exam is scheduled. So what does that look like? I think it starts with your online presence and your reviews, and that ends up going to your website. I mean, everybody's going to look at, what is the community saying about your office? What do your reviews look like? And if those are good, they're gonna go to your website. Once they get to your website, it's no longer adequate to have a website that's informational only. It needs to be operational. What does that mean? I think from your website, you need to be able to schedule an appointment. You need to be able to text with the office. You need to be able to describe or even go deeper into how flexible you are in financing and things like that. So there's a lot of things that you need to think about before the patient ever picks up the phone to call you. And if you're not fully optimized in those areas, it's a good place to spend some thinking time and say, how am I going to handle that? So it's not really all about marketing. It's about how we handle that call when it finally does get here. The patient's done all this homework, if you will, on you, and they finally pick up the phone and they call. And I think Jamie Reynolds shows an amazingly cool OrthoFi study from that may be a few years dated now, but that an overwhelming majority of the calls that go to an orthodontic office initially occur on Fridays, and an overwhelming majority of you are not open on Fridays. And if you're not answering the phone on Fridays, that's a no-no. I mean, this is kind of 101 basics. A lot of you have picked that up, but a lot of you still don't. And the next biggest call volume area was in the evenings. And that's where, when you have two parent families that work, that's when they have time to kind of do these things. And if they call your office after hours and you don't have a way to get back with them crisply or even have the phone answered in some manner with a virtual assistant or anything, you're losing opportunities. So those are two ideas that many practices are not optimized for any of this right now. So think about what happens before the consumer picks up the phone, try to optimize to that. And then I think lastly, you've got to partner with some people that give you some tools that you're comfortable with that do some things. And when I think about what OrthoFi does, there's two programs they have. One of them's been mentioned already. One of them hasn't. I'll kind of throw it back to you, Dave. But there's a program called FPT10. We need to do a better job with that name because nobody knows what that is. But I think it says for financial terms program 10 for 10 months. But essentially, if you're an OrthoFi customer and you use Align, there's a partnership between those two companies, the way I understand it, that gives you 10 months no interest financing on your lab bill. And that's going to allow you to feel more comfortable being more flexible. And so maybe, Dave, you could talk a little bit about that in your IMAX program that you've referred to before. But these are two just kind of no-brainers that if you're an OrthoFi customer and you're not using these tools, shame on you.
Yeah. No, thanks, Chris. Yeah, the FTP 10 program has been an awesome partnership with Invisalign. There is when you use Invisalign, there's obviously a cash flow that you need to think about in terms of the lab bill when the start. And what we're seeing within our data, even though we have open choice where it allows the patient to choose the down payment when it's an aligner case, an Invisalign case, we're actually seeing the down payment be 25% higher. So even in open choice, the practices are requiring higher down. If you require higher down, that's going to decrease your case acceptance, obviously, the correlation there. With FTP 10, it allows you to spread the lab bill out 10 months. so that you don't need to be as concerned with the cash out front. So it allows you to keep your down payment even lower, which will help to increase your case acceptance. So if you're not taking advantage of that program, it's a great opportunity for OrthoFi customers to do so.
How about IMAX? Just
And then
roughly
IMAX,
describe what it is.
yeah, IMAX is a partnership with Tina Byrne to help practices use the correct coding on claims to minimize insurance discounts. So if you're in network with a carrier using codes in the correct way, it allows you to lower the discount so it increases your production. So it tries to make it as simple as possible and make it more of a wizard for you in terms of like these are the right codings to be able to maximize your production. So thanks for the highlights there, Chris.
Yeah, that's I was just seeing some numbers last week about IMAX and the practices who have never done any, kind of breaking out of those codes. They're making upward of $400 more per in-network start when IMAX is working its magic behind the scenes. So definitely something to think about even, as you consider signing up with OrthoFi too. So I want to shift now and let's talk about the consumer for a minute because it sounds like we're seeing some pressure there. Dave, what are you seeing financially from patients right now?
Yeah, no, it's another great question here. Obviously, the Q1 was a strong start to the year. Uh, Everyone is aware that there's a lot going on right now in the world and AI and other things like that. So we're definitely keeping a close eye on what the consumer is doing. What we are seeing is, although the starts have continued to be stable or growing, is that there is some signs of strain from the customer, or sorry, from the consumer. And so the things that we're keeping an eye on are down payments and payment lengths. So within OrthoFi, we allow open choice, which allows the patient to choose what is the right down payment or what's the right payment length for them to be able to fit within their budget. In year over year, Q1 to Q1, we actually saw a decrease of down payments by about 2%. So patients are choosing to put less down because they're not feeling as comfortable with their finances, likely. And then they're also choosing payment plans that are about 5% more longer. So again, needing more months to make the monthly affordability fit into it. So we're also keeping a close eye on delinquency. So as many of you might have seen, that the credit card debt is at an all-time high. So that continues to creep up. Oil prices are going up, which is impacting people's affordability. Fortunately enough for the OrthoFi fleet, our patient AR has remained stable. However, we do look at it at a credit score level. So we do a soft medical credit check with the patient so we understand what credit tier they fit into. And Q1 over Q1, we are seeing a delinquency for the lower tiers creep up a bit. So it is a sign that there is at least a portion of the consumer that is starting to have a harder time keeping up with bills. So I think the key takeaways for me is in this environment, flexibility is more important than ever. So making sure that you're providing those low downs and the monthly payments that do it. If you are being more flexible, ensuring you have like rock solid collection protocols to make sure that you get the collection for the production that you've booked with them. So.
Right. Chris, when Dave was just talking about FPT10, he mentioned that, there are some practices still trying to require 25% down. I believe your notes said that you're even seeing 25 to 30% down required sometimes. How do you think that this impacts growth, especially in today's environment?
I'm going to pick on my generation. I'm the old guy on this call, but change is hard for older people. And if you've been practicing 25 years, what was pounded into you in the early years of your career was get 25 to 30% down, finance the rest over 18 months on a 24-month deal, and you won't have an accounts receivable problem. The data is so definitive on this, and this is really coming out of your shop, but it's just not a fact. And so you got to change. It may take my generation moving on and transitioning those practices to younger people who understand the data or accept the data or are willing to take a little bit more risk to change all that. But to my good friends that are my age, I would say you've got to be more flexible on financing, because to your question, Marla, what does it say when you're asking 25 to 30% down when we've already mentioned gas, but it's not just gas. It's groceries. We've heard about that in the news all year. It's for a lot of you, depending on where you practice, it's private school tuition. If you're looking at college, it's the cost of college. It's a lot of things. And so there's an authenticity gap where the consumer doesn't feel like you're in touch with the real world. And if you just offer flexible financing, let them pick the choice that you guys offer. It takes that authenticity and that acknowledgement that there's different kinds of pain for families in different situations. So I think you've got to do that, and the data is really clear. So you got to change to start more people. I encourage you to let go of the 25 to 30% if you're doing that. I have a lot of conversations with 55 to 65-year-olds that are still doing that. And I know that you'll grow more if you want to grow, if you loosen that up a little bit, and you won't suffer on a cash flow basis. You're still going to collect the amount of money that you're collecting the way you're doing it now. So, you got to speak to the consumer differently. That's important. You got to have tools. The ones OrthoFi provides on the collection side are probably the best in class. So you got to partner with a company that's got the tools. And you just got to be willing to be more flexible with your financing, and you'll see your practice grow.
Yeah, and then Shannon, I'm going to let you wrap up our section on, kind of diving down on the consumer section. So how should practices be thinking about growth in a tighter consumer environment? I'd love to hear your thoughts on that.
Yeah, so I think it's important for everyone to know that we are still in a K-shaped economy, and the K-shaped dynamic has been the framework for the orthodontic consumer analysis. So, really understanding that is important. The current K-shaped environment is creating a divide in consumers, premium consumers and value-oriented consumers. And what the data is telling us is the middle of the market is under the most pressure. So practices that are clearly anchored as a premium experience or, have accessibility, and practices that have high value options have a defensible position in the K-shaped environment that we're in. What does not have a defensible position is the practice in the middle, the undifferentiated on fee, on experiences, and on messaging. That practice is the most exposed to what consumers are doing right now. The good news is that the practices best positioned to weather this are not necessarily the biggest or the most established practices. They're the ones that are going to be invested in early financing options for the patients, and how they present their cases, and how they communicate value to the consumer. Growth requires all of those things. Something else that people need to work on is referral channels. Something that we started talking about last year was really honing in on your referrals, talking to them more, having more conversations, being more community driven in your marketing, and staying in touch with your referrals made a big difference, and the data proved it. Referrals were up 25% according to Gauge last year. And it's the same song every time you go to a practice. They're like, well, I don't really get referrals anymore. But the data shows that that's not true. Referrals are important. And practices that adapt in this environment win, and practices that don't are going to be stagnant or decline.
Okay. Wow, that was some very content-rich, that was a content-rich section. So love that. Now we're going to take a big old swing, and we're going to shift to the DSO conversation. And Shannon, I want to talk with you. I know that corporate affiliation dropped significantly in 2025. So talk to us about what's happening there and what we should expect in 2026.
Yeah, so corporate affiliation dropped in dentistry overall by 36%. It dropped in specialty in ortho specifically by 37.5% in 2025. And what I want to be clear about that number on what that does and does not mean. It does not mean that private equity is losing interest in orthodontics. It reflects that the market is effectively in a holding pattern, and here is why. We kind of have to think of it as a traffic jam. So approximately 70% of the private equity orthodontic and dental groups are past their anticipated hold window. The typical PE playbook runs 3 to 5 years, and many of these groups are at 7, 8, even 9 years. And that is not a growth story, that is a liquidity story. And until recaps begin to clear, new affiliated activity is probably not going to accelerate. What does that look like for 2026? It simply depends on whether the jam starts to clear. The moment recaps start happening again, we will likely see affiliated activity have a big uptick and quickly. The interest is there, the money that is there, the market just needs to get moving again. So, for anybody that is looking at that as their own transition option, pay attention on what happens with the recap activity this summer, and that is going to be your signal.
Right. So, Chris, I know you are privy to many of these conversations. What are you advising doctors right now when it comes to OSO DSO partnerships?
Yes, the environment in the market has changed a lot. Shannon wrote an unbelievable brief she shared with me this week or last week on how the groups are moving from kind of first generation 1.0 to 2.0, and really what that means is it's really not so much a let's go buy a bunch of practices and roll them up. Let's get really good operationally and things like that. So there is a shift. What I tell doctors, listen, some of the best advice I ever heard was actually from the founder of Smile Doctors, one of them, Scott Law. And he told me about 10 years ago, you've seen one OSO or DSO, you've seen one OSO or DSO. They are all very, very different. And they have different personalities, they have different leadership styles, they have different focuses and so forth. So, I think what I tell doctors is you've got to be selective. You need somebody that fits. These groups talk about to doctors about becoming a partner. And when you become a partner with somebody, it's just like in human relationships, you've got to click, so to speak. And so, find the groups that are the best fit for you. But if you've only talked to one, you've only talked to one, and they're all very different. So you need a sensei of some kind to help guide you, somebody that's talked to most of them. And there's a number of options for the doctors out there, but don't believe what your friend's experience was with an N of one. Don't believe the first conversation that you've heard, and they're all very different. And try to understand the nuances of what, Shannon's teaching me about, what's really changing with the money people. Because when we look at these deals, we will tell all the doctors, this is a great deal for you if you get a second bite at the apple. Shannon mentioned the term recap several times just a minute ago. And what that means is the next biggest, financing partner buys out the original one, and there's a liquidity moment where you get to sell some of the stock that you get. And otherwise, you don't get to sell any of it. And so as these recaps happen, you need to understand where these groups are in their recap cycle, what the probability is that they will recap, what the probability is of what kind of multiple that might be at. And there's groups like ours and others that understand that very well. So get a sensei, understand that it's changed. It's not going to take over all of orthodontics. If your kid wants to be an orthodontist and do private practice like you did, that's there for you all day long as far as I can see. But if you want to be part of a group, which many people do, those options are there. There's just they're about as rich. The numbers are about the same that they're paying, but how they're structured and who you go with is super important. So have somebody help you through that process. That's what we try to tell them.
Right. Chris and Shannon, I know that you guys work with practices that are, kind of working toward that transition, and some of them may choose an OSO DSO, some of them may be, being purchased by a sole prop doctor. Don't you have a session coming up at the AAO where you'll be kind of talking through those options and what a practice needs to know?
We do. We're going to be there April 30th, and this is for old timers who've been around a while. This is the old transition day that used to be the day before the AAO. And after COVID, they didn't bring it back, but a lot of people were still interested in it. So we're doing that on April 30th, the day before the AAO starts. And there is a registration page on our website.
Awesome. Okay, we'll see if we can throw that link in when we post this too. So if there's anybody interested. So Dave, let's kind of wrap up this OSO DSO section. Now, from OrthoFi's perspective, How are DSOs thinking differently about performance and growth compared to the individual practices?
Yeah. Yeah, I think the things that Shannon and Chris hit on, I think, are this a number of things that we're seeing as well in terms of, with some of the hold times being longer, the DSO teams are focused on operating the locations that they have, and so there's a lot more focus on getting it right at the individual locations. And so, I think the high performing DSOs are really thinking more in terms of system scalability and thinking about how do they leverage best in class partners and other things to make the clinics more efficiently. So work more efficient. And, to connect it back to what we were talking about before is if your team is busy with eligibility checks, busy with claims and things like that, they really don't have time for those personalizations and doing the pre-consult exam calls and doing that personal touch that makes the locations different. So really leaning into ways to make the practices more efficient and more personable, and doing that at scale. The other thing that I'm seeing high performing DSOs is really obsessing about data in a way that it really hasn't been the case in the past. So, there's a tremendous amount of scrutiny around data. Excuse me. Um, and really looking at each individual practice and what are the outliers, either good or bad. And so learning from the ones that are doing great and then, trying to improve the ones that are bad. So just that obsession with that. And then just finding new ways to leverage data to help with optimizing business results is just at a different level these last few years than it was in the past. So I think that's consistent with what Shannon and Chris were saying before.
Yeah. And we always say if you're listening to this podcast, you have a bent toward wanting to know about the data and wanting to be able to use that data in your own practice. So you're on the right track. Now just listen to the things that are recommended and stay on top of this. We do these podcasts quarterly, so we'll keep bringing you the data and fresh ideas to help you in your practice. So as we begin to wrap up, I want to give each of our speakers one more chance to address our audience. Chris, I know you have often painted a really compelling picture of what the future orthodontic practice looks like. Why don't you walk us through how you see that vision right now?
Yeah, I think it's more exciting than it's ever been. In the first half of my career, I witnessed a digital transformation on the business inside of orthodontic practice. We went from paper to computers, and we're still going through that, but it was a tremendous positive change for practitioners, patients, and so forth. Now we're going through the second digital transformation on the clinical side. And that's been ongoing for really 25 years with the advent of aligners. But when you think about what a digital practice means clinically, I translate it to aligners, digital custom braces with indirect bonding, some kind of patient monitoring package, and a retainer program when you're done with treatment. That's the full digital clinical realm, in my opinion. And I spent about 10 years really studying the financial journey that you go through because these are all lab-based products that cost you more. And what you have to get good at is titrating staff cost with lab cost. And so you can have the same or better overhead. And when you talk to an orthodontic consumer and you say, listen, I know mom or dad had braces when they were young and they went to the orthodontist once a month and they paid the orthodontist once a month, just like they do today. But they were in braces for 24 months, and that means they had 24 visits with the orthodontist. With digital orthodontics, whether it's with aligners or custom digital braces, you can do that in about 12 visits. So half as much. Today, the data on, I'll call them analog braces, but the way we do braces today is an average of 18 visits. And so would you like to have 6 fewer visits to the orthodontic office for the same price? And would you like to have the opportunity to maybe finish your case 30 or 40% faster, which is 6 to 8 months faster than your mom or dad did? And the consumer every time will say yes. Okay. So then you say to the doctor, would you like to have fewer appointments per case? Would you like to adopt this digital format? And they're iffy on that. The early adopters are who are going in all digital, like I just described, and they're outperforming. Anecdotally, I can't prove it, but I see enough numbers to think it's true. But they're outperforming the non-digital practices because they're speaking to the consumer in a language that they understand and want, and they're becoming good at it, and they're managing their overhead. So I think the doctors will come along, but the real story, I think, for the doctors is the future of orthodontics is you'll work fewer days, you'll have smaller footprints, so your occupancy expense will be a little bit smaller. You'll see fewer patients per day. You'll have higher daily production, and you'll probably have longer career longevity because with digital, you do the work on the computer to set up the case with your hands and eyes up front, but you don't have near the stress on your neck, your back, your eyes, your hands. And so I think it's an easier way to practice. And the story is, do you want more time back to the doctor? And the answer is almost always yes when you answer that question. And what they do with that time, we don't care. You can take more time off. Great for young doctors that have a young family. You can have more time to develop your team, something you tell me you never have time to do. You can have more time to think about developing your practice and growing offices or whatever you want to do. So that's the future of the specialty. It's very bright and you can do it very affordably. So I think it's a compelling argument. I think we're on the front end of it, and I think in the future you won't see analog brackets anymore. I think very little research and development is being done on analog brackets, and I think you'll have a patient come in and you'll scan that patient. You'll say, in our practice, it's all custom. You want custom aligners, you want custom braces. We'll get you done faster than the practice next door. We got this tool to monitor you when you're not here, since you're not going to see as much. And when you're done with treatment, we can keep track of that as well, so you don't have to come back. And so that's pretty cool. And I think that's the future, and I'm pretty excited about it.
Yeah, I love hearing you talk about that kind of long-term vision and really cool insight. So we've also talked some throughout this webinar about what the next 2 quarters will most likely hold for our industry. Dave, I would love to hear from you on what part will technology, especially AI and automation, all we're hearing about right now, what part will that play over the rest of this year and beyond?
Yeah, I mean, it's a incredibly exciting time with technology. I mean, Chris paints an amazing vision for what can be improved on the clinical side. Obviously, using technology and AI is just going to speed a number of things that Chris is talking about. But also from the business results side, I mean, the opportunity with technology and AI is feels unlimited right now in terms of the opportunity. Things are going to change. Things have changed in the last month, and it will continue to change over the next few months. And so keeping up with things is really difficult. I think the two areas that I'm really focusing on from an AI perspective that I think are relevant here is really around RCM and data. So RCM, I mean, the insurance companies, for as long as we know, have made things really complicated, which has made all our lives more painful. I just think with AI and the technology, there's an opportunity to streamline and improve the efficiency and the accuracy of everything that we're doing. So there's kind of some new terms that are coming out around human in the loop, which is really putting humans alongside technology to kind of fill in the holes where the technology can't be doing that. We've been doing similar type of things for over a decade now, where we're putting humans where the technology can't go. But with AI, we believe that the humans that are needed for this are going to be much more efficient and can be much more faster and more accurate. So we're excited to just really revolutionize how we do revenue cycle management with this new technology. So we're excited about that in the coming quarters and years here. The other thing is about data. So, we're obsessing about data. We're really leaning in advanced technologies on how to analyze and look at data. At the end of the day, AI is predictions. So it's trying to predict something and do it at really at real time and at really low cost. So we're looking at how could we change our product to incorporate predictions. So if you think of, will a patient show up for an exam? Will a patient convert? Will a patient actually pay you? Will an insurance company pay you? those are some of the real-time predictions that we're starting to look at. How do we incorporate that into our product? And if we can provide those insights, think about the value that we could provide in terms of optimizing business results if we can put those in front of people. So those are some of the things that I'm excited about for the coming quarters here.
Yes, I love this conversation. And thank you for calling attention to how OrthoFi is looking at and considering the role AI will play in our future. I know you're going to be talking more about that in an upcoming webinar, so specifically addressing AI in our industry. And that will be on Friday, May 29th. So to our listeners, be looking for the post on social media to register for that. Or you can always go to startmoresmiles.com and then the resources tab to register for any of our educational events. So now I want to wrap it up, Shannon, with you. I want to look at when you look ahead, what separates practices that will thrive from those that will struggle?
Great question. So one is, as we've talked about, and I think Chris and Dave did a great job of just all of their points. You have to know what your data shows. If you're not following your data, you can't make improvements. So if you're not looking at your data monthly, quarterly, start there, because you need to know how much that phone is ringing to make everything else start. I think people who are stuck in old models and ignore shifting behaviors are going to struggle in 2026. I think people who embrace efficiency and technology and use tools to help them provide a better patient experience, build strong referral pipelines and nurture those pipelines and adapt to consumer behaviors are going to win. I know I sound like a broken record, but patient experience, efficiency, and affordability are going to be key in 2026.
Great. Fantastic. Well, this has been another incredible conversation. And I think one of the biggest takeaways for me is this, that growth is still happening, but it's coming from smarter operations, better systems, and just more intentional strategy. So it's not just increased demand. We've got to think smarter about everything we do. Dave, Shannon, and Chris, thank you all for joining and for sharing, as always, such valuable insights. And then to everyone listening, if you're not already tracking these metrics in your own practice, now is 100% the time to start. And we will see you next time on Metrics That Matter.